Okay, welcome back, ladies and gentlemen. My name again is Larry James. My company is Speak with Larry, no spaces. And what I'm going to be talking about with you on this video is your account's age when it comes to your credit score and the credit systems, right? Now, how long your various accounts have been open counts for about 15% of your total FICO score. The scoring system weighs two considerations. One, how old is your oldest account? And two, what is the average age of all your accounts? Now, the older your accounts are, the better the system likes it. And here's what you can do to manage that. Open credit accounts as early in your adult life as you possibly can, assuming you can handle them like they should be handled. They'll just sit there in your report and build credit score strength for you over the years. When it comes time to make a big purchase like a home, your older accounts might make the difference in qualifying you for a lower rate. If you have plenty of credit and you have some new accounts that you're not using, close them. This will bump up the average age of your remaining older accounts. Don't open new accounts without a good reason. The next time you hear a store clerk offer to take 40% off the purchase price if you open a store account, then and there, simply decline. Just politely decline. If you don't, then that new credit line will show up on your credit report, and the negative impact of your score will probably cost you far more in the long run than any savings you might enjoy on today's store purchase. Now, of course, from time to time, you will have to open new accounts, but try to do it when you're not contemplating a major credit purchase like a home or a new car. If you can put some months or years between your last new accounts and your application for a big installment loan, this will help you. Let me say that again. That will help you. The new account will have become older, your credit score will be higher, and the rate on that home or car loan will be lower. And that's what you want. That is exactly the mindset that you want. Now I'm going to talk a little bit about mixing your credit types because that's important too. The credit scoring system looks favorably on variety, and credit mix weighs in about 10% of your credit score. Your score will be marginally higher if you have more than one type of credit. Now, what do I mean by one type of credit? Well, one basic type is the installation loan, which is a loan on which the amount owed is fixed at the beginning of the loan, and the fixed monthly payments consisting of principal and interest installments are required over the life of the contract. This type of loan comes in two flavors, secured and unsecured, signature, if you will. Now, a secured installment loan involves collateral, something that you agree to with the lender that will have the right to take away from you and sell it if you fail to pay the loan as agreed. And the most common examples are car loans and real estate mortgage loans. An unsecured loan does not involve any collateral. In essence, the lender agrees to make the loan on the strength of your signature, thus the name signature loan. A good example of an unsecured loan is a student loan. Whether they are secured or not, installment loans have a predetermined lifespan. If you make your payments on time over the life of the loan, the contract is paid off and the account relationship ends. For example, if you finance your car for 5 years and at the end of the period you pay off the note, you own the car free and clear and the account is closed. Make sense? Now, the other basic type of personal credit is revolving accounts. Credit cards fall into that basket, along with various types of store credit charge cards. The amount of the outstanding balance is not fixed at the beginning of the contract, and neither is the amount of the monthly payment that will be due. You can borrow, pay back some more, borrow and pay back some more, and on and on. This can go on indefinitely, month after month and year after year. That's why it's called a revolving account. And finally, there's a common loan type that is a kind of hybrid, a combination of both an installment loan and a revolving credit account. What I'm talking about here is the home equity loan. It has features of both basic types. With most home equity loans, you can borrow, pay back, borrow some more, just as a credit card, but it is secured by your home, just like a normal real estate mortgage. If you don't pay the bank, if you don't pay back, the bank can foreclose on your house, unlike a credit card. The scoring system likes to see a mix among these various types, and some things you can do to help yourself and your credit score are: one, try to have some installment loans, but not too many. Probably 2 or 3 is best from a credit scoring perspective. Probably at least one of them should be secured. If you don't have an installment loan at all, consider simply borrowing some money from your bank on a signature note, let's say $5,000, and deposit all that money into an interest-bearing account at the same bank. Leave it there and don't touch it. Arrange to have the monthly payments on your new loan paid automatically from your new deposited account. Now, to some extent, the interest on the deposit account will offset the balance on the loan, and in the end of the loan will only cost you a few dollars. Your score will benefit because you will have paid back a secured installment loan, always a good fact to have in your credit file. And if you don't want to put the loan proceeds in a bank account, you can still establish a secured installment loan. If you own something of substantial value, maybe a car that you can intend to drive for a while and you can own free and clear, then offer it as collateral on your new loan. Make the term short, pay it off as agreed, and help out your credit score. Have at least 3 revolving accounts in addition to your installment loans, and don't limit yourself to local or regional store charge cards. Accounts with national companies like American Express, Visa, MasterCard will improve your score more than accounts with local merchants. So remember that the next time you are making a decision as to whether or not you want to create an installment loan. Okay? All right. Again, Larry James, Speak with Larry. And as always, share with someone else what I've shared with you.